So today we've got unemployment data coming out. We've got NFP coming out, which is, of course, jobs added or not. We're expecting a lower number than previously. We're expecting 191,000 jobs today, which is interesting because if you get higher or lower than that, obviously it's going to move the markets. And this week, I guess another thing that to add to this week that makes it really important is the PMIs that came in really light this week. We see gold moving higher. We see the dollar having a really tough week. And this kind of makes sense when you understand that, well, you look at the full picture and you say, well, economic data seems to be slowing in the US. And, the question today is all coming down to jobs. But if we take a look at jobs data for a second, we can see JOLTS came in this week, not particularly impressive, but what really was a little concerning for the US story was this one right here. Take a look at services PMI. Now, services PMI, what is that for a second? Well, the services PMI is the services sector, the side of our economy that is focused on, services, which is a huge component of the U.S. economy. Well, in the last couple ones, we've seen above the 50 mark, which shows growth, right? Growth has existed in the services side of our economy. Well, we saw that analysts were forecasting for a 52.6 read on the services PMI. And instead, for the first time in a minute here, we actually got a much lower than expected services PMI, which is outlook for the economy in the services side, because this is the Purchasing Managers Index. These are all of the people who are making hiring decisions and purchasing decisions within services companies. And if they're projecting into the future that they see a decline coming or a slowdown coming in their activities, that's a leading indicator in many ways to what the US economy might look like in the future. So we get this number and the market just absolutely reacts to it, right? The dollar was down. We see gold shooting higher off of economic slowdown concerns, as well as perhaps rate cuts more likely to happen this year off of this data. And that's following another one that was key earlier this week, which was the manufacturing PMI. So manufacturing and services are both below the 50 mark, showing some material slowdown in the forecast for the economy. So when you look at that, you say, okay, we've got slowdown in the economy. We've got inflation on the producer price index and core PCE numbers coming in much better. They're coming in much lower. It looks like the Fed may start to cut rates, and that's what the market is saying. And we see that in the price of the dollar, right? The dollar declining. We see gold going up. We see at the same time yields coming down. So you've got this story where overall, it looks like the Fed is more likely to cut than not now in 2024. So certain areas of the market are definitely reacting. We see the NASDAQ continuing to push higher. This makes sense because, of course, a lot of technology, the IPO market, the borrowing costs are higher for companies that are trying to grow much bigger and require borrowing costs. So we've also seen the Russell still kind of go sideways because there's a caveat to all of this. For the Russell, for certain companies, especially sensitive companies to the economy like the Russell, which are smaller companies, they need to see not only inflation cooling, but growth stay strong. And this does flag some concerns about growth because, again, the perfect soft landing is you see just a very modest, kind of cooling of the economy in line with cooling inflation. So today's figure that we're about to see the NFP number, the jobs data, is really, really important because if you want to see inflation continue to progress, you want the jobs data to come in cooler than expected, right? We were expecting for 191,000 jobs. You're expecting some cooling there. If you get that, then the market will celebrate. But the concern here for me is that if jobs data comes in really cool, by the way, we've got 8 minutes to go on that, you have to be really cautious with this because if jobs data shows signs of cooling, it could, kind of become more of a landslide, right? That's the thing about this stuff, is that if the jobs data starts coming in really cool, it could really kind of snowball into a bigger problem. And yes, you may see inflation come down, but you may see the jobs data start to come in really weak.
Our summer software sale is happening right now, which means you can get the Edge Finder for 50% off. COT data, top setups, pages of fundamental and technical data, and so much more. Our software is constantly scanning for new data and information and is updated regularly. The Edge Finder is a one-time purchase, which means you can get it half off right now and never have to pay for any updates made to the Edge Finder software. This limited time offer won't be around for very long, so don't wait and get this incredible trading software for half off before it's too late. Check out the link being dropped in the chat now to talk to one of our team members about our huge 50% off summer software sale.
We're getting really close here, guys. We got, we're about to get the news, so let's go ahead and see what we've got. All right. And NFP's just come out here. Okay, unemployment rate. Oh, that's CAD. Jobs data came in at 206,000 jobs for the U.S. Average hourly earnings came in as expected at 0.3%. So, and then we had a unemployment rate tick up at 4.1%. So far, that's definitely going to be mixed in my view. You do have the market selling off on the dollar, which is, interesting. I think it's that 4.1% that is getting the attention, because jobs data came in pretty much as expected. You can see 206,000 jobs compared to a 191,000 forecast. But what's interesting here is that the unemployment rate did tick up to 4.1%. The dollar is moving lower off of this data here. Again, here is your 4-hour chart view. Very interesting to see that there. And gold now pushing back up. Look at that quick wick lower and reversal on gold. Again, an unemployment rate ticking up into the 4.1% is trending higher. I mean, that's a continued upward trend on the unemployment rate, which is going to get the Fed's attention, I think. At the same time, here's NASDAQ pushing higher on this. I think that if you actually take a look at this data and you say, well, is it a big surprise? I would say not particularly. 4.1% is a surprise, but the change in jobs was not a particularly strong surprise. A strong surprise would be like 250. Oh, and look at this. They just revised the previous numbers. Let's see, revised from 272. Oh, that's the figure right there. They revised the previous number from 272,000 jobs, which this is what Jerome Powell actually said in his speech. He mentioned that jobs data on the last one, he said, I think that might be a little bit misleading or a little bit off. And certainly it actually came in lower now. They revised the previous month's jobs data from 272,000 jobs down to 218. So now we've got a picture that is actually straight up dollar weak. Because now that just makes sense. Now you've got revisions lower. So if you actually look at jobs data is coming in really light now. Not only did you have a JOLTS jobs numbers that came in, this week, but you also had PMIs weaker. You have now, again, revisions lower. That's a significant revisions lower, and unemployment rate ticking higher. Average hourly earnings aren't here to save the day in terms of the US dollar either, because again, 0.3% is kind of a much more appropriate figure. That's probably causing gold to fly. Look at that. There's gold. This is fantastic for gold bulls out there. Congrats if you're on that side of the trade. Yeah, so Kenzo, we had jobs data come in a little bit lighter. Now, the actual NFP, the actual print came in about as expected for the actual number for June. However, the revisions lower really changed the picture pretty quick. Suddenly you had a revisions down from the month of May, down by, I think it was like by 50,000 jobs or 60,000 jobs. So what we see is cool data on the jobs front, and that's following a week where we've had cool data. We've seen PMIs come in lighter, both in the services and the manufacturing section. I mean, Kenzo, the last time I spoke with you, you were talking about the dollar, and you were talking about how it looks a little bit top heavy, and it seems like you might have been right about that. Do you think the dollar has more room to the downside here?
Yes, you're right. With the economic news that we received already, most of them, or let's say 80% of them, they're all pointing down, which is good. It's actually good. So now, just because we are on a new month, it's like we just have to know what's new with the maybe CPI and retail sales. But for now, or until now, I'm confident that maybe we will see a continuation of that sell, even though at the moment I think this area might look like actually a nice support, but I think maybe the market might reach this level. From there, I think maybe we will have to decide if are we going to get a breakout or maybe the market will reverse. But at the moment, things don't really look good for the dollar, and that is good for the rates. I think maybe they will change their tone with the rates cuts. Maybe they will add a second, or let's say twice. Maybe they will cut twice, because at the moment they promised one. Maybe they will change their tone, and if they do that, we will see some very nice moves from Nasdaq, gold, and US 30s.
Yeah, and the thing is, Kenzo, I think that you might be right about that, because the last time Jerome Powell spoke, he seemed he came out pretty dovish. The market actually rallied just on the antics of Jerome Powell last week, or actually was that this week? I'm losing track of time. But the last time he spoke, at that ECB panel, he sounded pretty confident that the Fed had really made substantial progress on both of their mandates, which maybe preceded a little bit of what we've gotten this week, which has been slowdown in PMI data, not crashing but cooling, and at the same time you've got a pretty good case to be made, like you said, for a second rate cut to be pictured into this year. And if that happens, as you mentioned, a lot of these parts of the market that have been very much waiting for rate cuts, like perhaps real estate, perhaps technology's not really even waited for anything because it's just ripped higher anyways, but maybe it will give some extra confirmation to things like the NASDAQ, et cetera, that are a little bit more rate sensitive with their higher exposure to technology. And then you also have the idea that the dollar weakening, for a little bit there, it looked like the dollar was just going to be strong because of its outperformance to other economies, which it may still outperform, but maybe at a much narrower kind of basis. But you mentioned gold, you mentioned the NASDAQ. What are your thoughts on gold?
Yeah, I think gold, since we had a very cool event, or let's say mixed, it's not really that bad. So let me see, on a 4 hours time frame, it seems like the market is still trying to go even higher. So let me zoom that a little bit. So I had this structure, so now we also have a smaller area there. So I think if the market gets out of that, we will see a nice push to the upside. This gives us a very nice room to look for a continuation of that buy. Plus, as long as the market respected our support area, I think we did talk about that last week, where the market was respecting that, we were expecting to see a very nice bullish move. Yes, if it goes up, the only level that I will be expecting to see a nice reversal, maybe it will be at that top resistance on top there. But at the moment, to me, I think we have enough room to see a continuation of that buy. Everything that we saw, most of all these major events, they are cooling off like aggressively. So this month might be worse.
Yeah, no, I definitely agree with you. I think that the path of least resistance for gold, at least right now, is to go back and retest those highs unless something changes. But you've had just a string of kind of proof, I guess, if you will, for gold bullishness recently. PMI data coming in light like that is a real sign that forward-looking indicators are showing slowdown in the economy, that's bullish for gold by itself. But you couple that with the ideas of rate cuts, as you mentioned, perhaps two now being. Actually, I just did the FedWatch tool, Kenzo, and it actually did show probabilities are now have just swung to slightly favoring 2 rate cuts by end of year, December 18th. So I thought that was really interesting. And so we're looking at a potential rate cut. So and next one I wanted to ask you about is, you mentioned the NASDAQ. Do you have any positions on the NASDAQ, or are you watching for a setup?
I was waiting for the news, but already we had actually a pending order ready there. So obviously, maybe once the market opens, it's where we will see maybe the market trying to go up. So this shows the strength of the tech stock. We have we just received NFP, and we see that there's any aggressive move. So that is actually positive. Already we have a bullish momentum on the stocks. So I'm expecting to see a very good Friday. I think it's gonna go higher maybe later on.
Yeah, it's been so strong. Technology has just, obviously led this whole year, really. And I think that with the prospect of rate cuts, Kenzo, my personal exposure in terms of sectors, I have long positions on energy and on technology. And technology is a weird one because it's the only one that's really performing, but it can continue to be the one that performs the best, because I would make the case that, if you're going to see rate cuts, and the next conversation might start to be, well, how much are we going to see the economy cool down? In that scenario, I still like the tech story, simply because they have the cash reserves, those big companies, Google's and Meta's and Amazon. It's hard to poke an argument against how strong their balance sheets are, how solid their cash flows are. If we see an economic slowdown, it's almost like, do you even want to abandon the big mega tech trade? I think that for me personally, the answer would be no. I still think those are the best kinds of companies, even if you see a downturn, to be long those sorts of companies for the longer term. Barring we have a straight up, kind of 2008 type recession, the overall story for those companies is just easier to get behind. Now, the challenging part, I suppose, is that they are priced very, very richly, because everyone knows that, right? They're the safe companies, but at the same time, even the safe companies can get overvalued. So I don't know. It's an interesting one. If you were to, just out of curiosity, if you were to take a position in the NASDAQ, the Dow, or the S&P, which one would you hold for 12 months from now? I'm just curious.
I think I will actually go with tech stock. Currently, you see sometimes things, let's say interest rates actually they are still higher. And maybe we can compare with few years ago, let's say 2008 and stuff, where maybe we saw some of the tech stock were going down. But this time, I think they are positioned differently, because that time and now they have a seriously good balance sheet. They have hard cash. Everything is better than before. Tech is now adapted unlike before. So for them just to crash like that, I don't think that will happen, even if they don't cut the rates. So there is a room for cushion. So I think I can just buy and hold for more than 12 months. I think we're still gonna see some very nice highs.
Yeah, no, until you see something really introduced. Here's the one thing that I've talked about, Kenzo, in the past that I think is, it's like a tornado watch, if you will, which is, if you get the Fed to cut interest rates, and then the economy kind of steamrolls ahead, and we actually see inflation reaccelerate. If you start seeing signs that the Fed is battling inflation for round 2, then we might see a bear market. We may see some serious corrections. But right now, it's kind of just like smooth sailing until it's not. I think that, as traders, as investors, for me on the trading side, it's like, I don't want to try and anticipate a bear market. I want to, kind of when that comes, which it will come, be prepared for what could happen. But in the meantime, stocks are strong. The companies are looking good, and as long as you don't get further acceleration on the economic decline side, I still like the story. We'll see where that goes, but we will just have to kind of see what else are you watching in the markets right now.
I was actually also watching some of the currency pairs. We saw GBP USD. It was like seriously pushing higher, and the moves here were a bit confusing because we were just coming out of this downtrend structure, but it seems like now the market will be going higher. So, and this NFP did not even try to move the market. So at the moment, it seems like every pair agrees with us to say, you know what, the dollar, it's losing some momentum quite slower. So maybe we'll end up seeing a breakout of that structure, maybe seeing a continuation of a buy. Even on the, like, let's say USD JPY, we know that very well that JPY is quite weak, but we saw a US trying to reverse. So that showed us that actually USD, it was indeed losing some momentum, even though now it's trying to reverse again. I think this reversal can still continue. Yes, the overall structure, it is still that bullish move, but I still believe that maybe we will see a nice reversal to reach that level. So this is other things that shows us that, yeah, dollar, it's losing momentum on both sides. It's not only on certain pairs. So yeah, on currency pairs, I was just looking at this few. So mostly I was actually on gold, Nasdaq, and S&P. S&P 500 at the moment is just the same as Nasdaq 100.
Sure. Well, yeah, no, I think it's going to be interesting to see if that dollar yen can finally get a little bit of a relief pullback. It's been such a dominant uptrend recently, just with the Bank of Japan really struggling with their growth story. And again, the dollar has been really strong. So perhaps this round of data may give a little bit of a chance for the dollar yen to catch its breath, if you will.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.